Right beneath the surface of the global economy runs a hyper-fast digital engine, constantly calculating the price of tomorrow. These are the metrics of CBOE, the world's leading derivatives exchange. In the third quarter of 2025, they processed an average of 18.7 million options contracts every day, generating $605.5 million in net revenue. To the outside observer, these high-frequency numbers suggest a system built for speculation, a digital environment designed for high-stakes betting. Strip away the fiber optics, and you find a mechanism rooted in a much older problem, the terrifying uncertainty of the harvest. Human survival once depended on the weather. To manage that unpredictability, we created the financial derivative, a tool designed to transfer the risk of a bad year from those who couldn't afford it to those who could. In the 6th century BC, a philosopher named Thales of Miletus executed what is widely considered the first option. He predicted a massive olive harvest and paid a small deposit to the owners of local olive presses during the winter. That deposit locked in a set rental price for the following summer. By the 1730s, that basic concept had evolved into a formal market at the Dojima Rice Exchange in Osaka. Merchants began trading empty rice contracts, which were standardized tickets representing crops that had not yet been harvested. Then, in 1848, 25 businessmen founded the Chicago Board of Trade, or CBOT. They industrialized the concept by standardizing contracts for grain, turning local, erratic trading into a predictable, high-volume market. This chart shows the mechanics of their core product, the futures contract. It is a binding agreement to buy or sell a commodity at a set price on a set date. The risk here is linear. If the market price moves up or down, the farmer and the baker are locked in, meaning one person's profit is always the other's exact loss. These contracts provided security, but they were rigid. They offered no way to adapt if the market changed, locking producers into a single price regardless of new opportunities. In 1973, that rigidity was challenged. Joe Sullivan launched the Chicago Board Options Exchange, or CBOE, operating initially from a converted smoking room. CBOE's contribution was the creation of the standardized option contract. Look at how the risk profile changes in this graph. Unlike a future, an option is a right but not an obligation to trade an asset at a set price. The previous straight line bends into a curve. The buyer pays an upfront fee called a premium. This creates a floor on the graph, capping the maximum loss at just the cost of that fee, while leaving the upward potential for profit uncapped. This same year, the Black-Scholes-Merton model was published. This formula provided the mathematical framework to price time, volatility, and probability, allowing traders to calculate the value of these curves with precision. Standardizing the contract and solving the math meant risk was no longer a physical burden. It became an abstract asset that could be priced and traded independently from the physical commodity. In the modern digital market, many of the underlying assets have no physical form at all. In 1993, CBOE introduced the VIX, a tool that tracks the market's expectation of near-term price changes. This is commonly known as the fear index, and it allows participants to trade implied volatility itself rather than just the direction of a stock. That risk has been sliced even further with 0DTE, or 0 days to expiration options. These are contracts that expire on the same day they are purchased, focusing market activity on extremely narrow windows of time. This chart shows the rapid adoption of these short-dated trades. 0DTE options now account for nearly 60% of the total volume for the S&P 500. CBOE is now moving into prediction markets. Their 2026 framework includes payout zones, where traders can earn a return based on the partial probability of an event, rather than just a simple yes or no outcome. Modern exchanges have moved past the physical. They are now massive engines for trading pure probability and market sentiment at the speed of light. We have transitioned from the physical exchange of grain to the high-speed transmission of data through the CBOE Titanium network. Over centuries, we have translated physical dangers into mathematical formulas, then into code, and finally into a global infrastructure for managing risk. The scale of this transition is reflected in the market. CBOE Global Markets, an exchange once defined by its physical trading floor, now holds a market capitalization of over $25 billion. a valuation built on the global management of abstract probability. As long as the future remains unknown, we will continue to build faster and more complex engines to price and trade the uncertainty of tomorrow.